this is going to be the last day in which we're going to have the system here where everybody's being in this room, where we have apparently 2, 5, 6, 7, 8. We still have about a dozen more people than we have seats. It's going down, you notice. How many here are listeners? 1, 2, just 2 of you. So it's going to be kind of a 3-tier system starting next week, starting next Monday. There's going to be a block of seats. I would appreciate if the block of seats in the front and center here be reserved for the CRE students, the MSRED students. And so obviously, if any of you MSRED students don't come to class, it's going to be glaringly obvious it's going to be an empty seat there. Then the other remaining seats in this room, it's first come, first serve, with the exception of the sort of the third tier here is I would at this point ask listeners to wait and see, wait until class starts at 4:10 and see if there's open seats for you. So anybody for whom there's not an open seat, including the listeners who've waited, or anybody who's gotten here, not in time to get an open seat, we'll have the conference room across the hall open for you. And Mike here will be live streaming the class. There's a feature, so you just get it up on your laptop, and there's a chat feature there if you want to, send a question in. We will have to designate a system where one of the TAs is receiving those questions, right, and can relay the questions. And any one of you over there in the conference room, you can plug your laptop into the projector over there, and then the class will stream on the big screen on the wall over there. And everybody in the class will be able to review the recorded lecture at your leisure, afterwards. So I think this system will work pretty well. I do anticipate that as the semester progresses, we will actually all be able to fit in this room, because I know that there's always some drop-off, even among you who are seriously taking the class now. And so as that happens, I do think we'll actually have room, partly considering the fact that there's never 100% attendance, in any given day. So I think this is going to work. I don't think I'm going to have to cut anybody out who doesn't want to seriously take the class. Having said that, we're basically using the criterion. If you handed in the homework, homework 3, we're assuming that you are seriously taking the class, whether you're currently registered or not. If you haven't been handing in the homework, even though you might be currently registered, and you're registering for credit, not a listener, then there's a disconnect there, and so we're probably going to be looking to cut those students off the list. I assume maybe none of those are even here. So, okay, without any further on that, let's get into today. I want to do 2 somewhat different topics today. First, we want to, based on the homework assignment, we want to go back to the Walden case and now, once again, focus on the economics of the Walden case, the investment decision from an economic perspective. Now we're going to do it quantitatively. Previously, we've talked about it, the investment decision, qualitatively. And the way we're doing it at this level in Module 1 here, we're going to be quantitative now, but it's back of envelope. Okay, it's not very deep or rigorous or complete. We will be getting into a much more complete and rigorous, in-depth model of the economics of development investments in the 4th module in this class. But for now, it is important that we begin to get the basic economic, or sort of a first level of an economic analysis of a project like this. And so that's really what the homework today is about. And I guess we have this Exhibit 9 that was given to you in the case. And the type of numbers that are in Exhibit 9 are very typical of the kinds of numbers that developers, investors look at in the real world in a project like this. And gives you an idea of the level of depth that decisions are often made at in terms of quantitative analysis. So Exhibit 9 kind of walks you through the steps of the metrics to compute. These are all very simple sort of ratio kind of metrics. It's not much sophistication in terms of, recognizing the time value of money or the risk and so forth. We start out with the 1984 numbers that are given in the case, and then we're going to kind of move those forward to the decision time in the case, which is actually 1993, 9 years later. And we'll use some information from another exhibit to do that. In particular, Exhibit 7 shows you how the rents have been changing over a fraction of that history. And we'll use that change, and we'll kind of extrapolate from that to estimate what the rents would have been already by 1993. And then there's this question of, they actually bought the land in 1984. So they tied up, they paid $3.1 million cash out the door in 1984. So that money has been tied up. It's been lost to them for all that period. So if we try to include that as their cost, it's kind of effectively their cost in some sense, then what would the project look like? And we're going to use this 10% interest rate, just kind of plucking it out of the air. It is not untypical of interest rates during that decade, when there was a lot more inflation than there is now, and just the whole monetary and financial systems were different, and so interest rates were a lot higher. And then did it look like a good investment? And we will generate a random student.
Stephen Burt.
Who's it?
Stephen Burt.
Steve Burt. Okay, Steve, you want to take us at least through the first part of Exhibit 9?
Sure. So the first part we did was calculate the change in gross rent from 1984, which was $23.50.
So we're gonna do this in 1984 and 1993. Okay, so let's take the top line is the potential gross income. That's the rent that the property can earn, or the revenue the property can earn if it's fully leased out.
Right.
And in 1984, the case said they're assuming they can get $23.50 a square foot. These are all per square foot numbers. So in 1993, how are we going to put your name in here?
We're assuming a decrease in rent down to $17.40.
Okay, how did you come up with that?
Yeah. We're taking like the difference between like the 1988 rent and the other side.
Here's Exhibit 7.
Yes.
And data was not nearly as available back as you go farther back in time. But apparently, there's rent data from 1988. This is market average rent, market average vacancy, and it's falling over the entire stretch of time that we have there. We can only guess what was happening between 84 and 88, but it would seem like maybe a reasonably conservative assumption to assume that the change from 84 to 88 was, let's just assume it's the same as the change from 84 to 93. Let's just take the change from 88 to 93 and assume that's the change over the entire history. Maybe it actually went up a little at first from 84 and then down, or maybe it was flat, or maybe it was declining all the time. Point is, I think this is as good estimate as any. So we wanted to take that off of the 2350. So I think the number you want to get there is 20, isn't it? How many people have a difference of opinion with $20? That's the top line. Okay, are you okay with that, Steve? You have a different number, but
yeah, we had 17, but okay.
Well, maybe that's a couple lines further down. Anyway, we need to subtract something for vacancy.
Right, yes, we subtracted $1 from vacancy to reach a $16.40 adjusted gross.
Right, that's what the case told you to do. Very simplistically, just trying to make this not too complicated for you guys. The case said to allow $1 for vacancy, and I just said, let's keep that the same for 93 and 84. So that would get us down from 20 to 19. And then operating expenses.
We grew operating costs by $1 in 1993, versus $6.50.
Right. I think that's what the assignment said. Let's assume that inflation in operating costs would have brought that up to 650.
Right.
So then we come to a crucial bottom line.
Right, and then we're calculating cash flow from operations, adjusted gross minus the expenses. And we got 990.
Right, but you were starting from a wrong top line. Right. So I think this should be, we're going to take 750 off of this. It should be 1250, right?
Why would you assume that the vacancy costs are similar in 84 and 93?
I'm just being simplistic. I'm just trying to make it easy for you guys.
They didn't give you a vacancy table, and
yeah. I appreciate that some of you guys went in greater depth on that, and that's great. Yeah, in particular, here we have the vacancy, the market vacancy. Was rising this whole period, or it certainly rose very much from 1984 when they were allowing the $1. But there's a crucial difference here between market average vacancy and the vacancy that you project in a building that you're going to be building brand new. The market vacancy certainly reflects the strength of the rental market, the supply and demand, in the rental market. And so the fact that this vacancy has increased in the market since the time when they were allowing the $1 does imply that there's more of an issue there. But the way this would actually play out in a more complete and realistic development analysis is, instead of doing a simple ratio like we're doing here, you'd actually have a multi-period projection of what are the cash flows going to be in this whole project as we go forward in time. And the crucial part of that is going to be, how rapidly is the building going to lease up? Because you're not going to build a building that you think is going to permanently have too much vacancy. You would redesign the building, aim at a different market, or make it smaller or something. So you assume you're trying to do this project such that the building will pretty much lease up. That doesn't mean 100% occupancy, but it probably means like 95% or something like that. So the question is, how long will it take you to get up to that? Can you do it in the first year right off the bat? Is it going to take you 2 years, 3 years? And that's going to greatly affect the present value calculation of the project. And if the market is so weak that it's going to take you 3 years to lease it up, that's going to clobber the economics of the project, and it's basically going to say, wait, you can't build it yet. You got to get a stronger market to build it. So that's the way that's really going to come into play in a more complete analysis. For our purposes here, we're trying to do this back of envelope, very simple economic analysis. I said keep it at $1. Okay. So let's give somebody else a chance. Next random student is
Anne Martel.
Oh, no, I think it was Anne Martel.
Oh.
Not him.
So
Yes.
Yang Xiao. Yang. Xiao. Yeah.
Xiao. Is that first name or last name? You have these cross-cultural linguistics. But here we're identifying students who are actually not taking the class, right? They're not going to.
Van Alstyne.
Oops.
Van Alstyne.
Van?
Yeah. Christopher John. It's like one. Yeah.
All right. So is it Chris? Is it Chris? Is that?
That is coming, Chris.
Very good. Chris says. The projected sale price. What we're gonna. This is the most important single number, right? This is the value of the thing you're producing, the projected value, what it's going to be worth in the property market when it's done. So how do we get that?
So that one, what I did was we took the cash flow and divided that by the cap rate.
Right, cap rate on cost or cap rate on value?
Cap rate on value.
Yeah, because we want to get the value of this building at this point. So we want to know how much the benefit is, how much the value of the asset that we're creating is going to be worth in the property market. We'll subtract out the cost a couple of rows down. But so in 1984, they said it was a 9% cap rate. Applying that to the $17 net rent projected in 1984, we get the $189 projected value. But by 1993, and I think we just said assume the cap rate remains the same, or maybe I didn't even say that, but I didn't give you any other information about cap rates. And in fact, actually, cap rates probably were about the same. Cap rates tend to be more stable, right? The cap rates are relatively robust numbers because the things that can affect a cap rate tend to offset each other. If there's inflation, that tends to be in the expected return, the discount rate, the opportunity cost of capital, but it's also in the expected growth of the rents and the values of the property. So those two things cancel out. So in any case, Chris.
Yeah. So then for 1983, we had cash flow of that was $12.50.
Right.
And then using the same cap rates, that turns into a value of $139.
Okay. Anybody get anything different? Good? That sounds familiar to me. Yep. Sorry. Okay, so the asset that we thought when we were looking at this thing back in 1984, we thought it was going to be worth $189 per square foot when we completed it. By now, it's looking like it's only going to be worth $139 per square foot. That's a big drop. That's a $50 drop in value starting from basically 190. So that's that's like a 30% drop in value or something. If you look at price indexes of commercial property back at that time, yeah, there was indeed a 30 or 40% drop in the values of the typical office building in the U.S. between the mid-1980s peak and the early 1990s trough. So this is kind of realistic.
When do you include the carrying cost for land?
We're getting there. Okay, so now what about the total cost? Yeah, actually, glad you asked that question because here we are. So the total cost in 1984, we've got $3.1 million for the land, plus $21.8 million. I'm sorry, $3.1 million for the land, and $21.8 million for the construction. Dividing it by 148,000 square feet is $168 per square foot. All right, construction cost and land cost, the total development cost. So 1993. Let's generate another random student. Let's really spread this out.
It's Adriana Sandoval.
Adriana.
Yeah.
All right. I'm going to take this on.
Sorry, where are we? Total cost for 1993.
Total cost 1993. This is going to include, I think I said, let's assume the construction costs remain the same.
Cost per square foot.
Yeah, either way, you can.
Well, we had a slightly different figure for. Oh, that doesn't matter. We got 196.44.
Okay, can you tell us how you got that?
It's probably slightly different because we did something with the vacancy where we made it proportional to the average change, the change in average vacancy rate. So we had a different.
You mean you made the
actual
construction cost function of the vacancy rate that the building is going to have?
So we had a different cash flow because we were estimating that.
Right, but here we're on the that relates to demand, that relates to value. Here we're on the supply, on the cost side. So it's just construction cost and land cost. right, which is independent of vacancy or rent or net income or anything like that. Does somebody else in her group want to help her out?
Sorry, I'm trying to figure out how we got to this number.
Well, that's okay. We don't have too much time. We've got to move on here. Another random student, please.
Is Allison Crowley. Allison.
So you take the $21 per square foot in land costs that you can find in the development budget, and it was Exhibit 10, and we inflated it by 10% per annum for 9 years, like the question said. So
Okay.
that got you the additional total cost.
So we start out at $3.1 million for the land, and then it's as though they're giving up, they could have put that $3.1 million in an account that would have earned 10% interest. And so therefore, as of by now, they've given up 3.1 million, growing at 10% per year, compounded for 9 years, which that number was what?
So we did it on a per square foot basis, so I have that calculation.
Okay.
$21 per square foot was the initial cost in 1984, which I think if you multiplied it by your buildable square feet, you probably got to that 3.1 million.
Yeah, okay.
So on a per square foot basis, it inflates to $49.52 on the overall per square foot costs of the project.
Okay, so that would have been, in other words, you're saying it's like, so the 21.8 remains the same, construction cost, and you're saying the land cost.
The land cost was what changed, and it changed from $21 per square foot, which was a portion of the
Yeah.
overall development budget, to $49.52 per square foot, or an increase of $28.52 per square foot in total cost. So for our total cost number, we got $197 per square foot in 1993.
Okay, everybody good with that one?
Yeah.
And just to show here, here's what's going on actually. If we grow that $3.1 million at 10% per year for 9 years, it becomes $7.3 million. By the 7.3 million, by the 148,000 square feet, and you get the 21 or something. And then you add that to the construction cost, which was $21.8 million. Divide that by 148,000 square feet, and you get whatever you get there, and the whole thing totals up to 197 per square foot. 196, whatever, close to it. Okay.
What about the extra 6 million that say the case?
Yeah, so they also they had some out-of-pocket costs during that whole period of time. And should we attribute that to the land, or how should we assign those costs? Maybe it's like overhead for the company. Do we want to, I agree, those are real costs, but I think I told you to ignore them. Believe me, clearly we've got enough cost in there now to totally sink this project. So, okay, so then the gain. So now just comparing the value of the thing you're getting with the cost, right? So, I'll ask for volunteers now. Who wants to go next with this line? Nobody? Allison, keep going.
So that's a loss of negative $58 per square foot.
So let's go back to 1984 first.
Oh, and 1984, sorry, it was a gain of $21 per square foot.
Right, so it's $189 per square foot building that we're getting by paying $168 of cost. So that's $21. It's a positive gain. But in 1993, we're down to, the value is 139, and now our cost is up to 197. So this is going to be a negative proposition.
Yeah, negative 58.
Negative 58. Okay. So, okay, and then we have these other metrics. Do you want to keep going, Allison? Cap rate on cost.
Yeah.
Also known as ROA. There's all sorts of terminology here for this number. This is a huge, this is really just another cap rate, right? And there's all sorts of terminologies for cap rates. They're called cap rates, they're called capitalization rates, they're called yields, they're called cash yields, they're called income yields. they're called initial yields, they're called ROA, return on assets, they're called OAR, overall rate. All these different words for the same thing, only sometimes with subtly different ways that they're applied. Like when you say assets, return on assets, so that's in the denominator. Do you mean the value of the assets, what you could sell it for today in the market, or do you mean the cost of the assets, what you would have just paid for to get the asset? The numerator, the yield, the income. Do you mean the income like the accounting income, the net income of the property, or do you mean the actual net cash flow? They're not the same thing because capital improvement expenditures are not an expense, but they are a cash outflow. So all of this stuff, you will get, over time, you will get familiar with all these subtleties. By the end of this semester, I think you'll be pretty good at it. It takes some time because the way this is used in the real world, or even in the academic world, we can't, except by being absolutely explicit every time the word is used and say, by this, at this point, we mean exactly this. You can't know except by the context and by kind of figuring it out from what went on before and so forth. And it will be the same when you're out there in the real world. People will be quoting these things, and you don't necessarily know exactly what they're referring to without quizzing them further. So, the cap rate on cost that's implied by these numbers is going to be the net income divided by the value of the, by the costs. So for 1984, it's what?
10%.
Okay, but what's the numerator and denominator?
It's going to be your NOI over your costs, so $17 per square foot over $168 per square foot.
Right, so that was our basic 10% cap rate on cost number. If the case said Lindy thought that was good enough, that's going to provide him with enough profit to make this project worthwhile. Even though they said that at that time in the market, most developers would want to get 11%. But he was willing to do it at 10%, maybe because what would be a logical reason why we would be willing to do it at 10% when mostly the market's requiring 11%?
He thought this is a superior project which reduced the return requirement. Risk is less.
Yeah, remember, this is just the initial, so as Fanny says, this number is just the initial return. It's just what you're getting in the first year as a fraction of the cost that you laid out. He's going to spend $168, and he's going to get $17 back in the first year. But what if he thinks this project is, like I say, it's really on the cutting edge. It's going to catch this wave. And for this project, we're going to be able to raise our rents more in the future than for the typical project. And so even though the first year it's going to be lower than for the typical project, we're only going to get 10% back, by the time you get to second, third, fifth, 10th year in this long-lived thing that we're building, it's going to be generating more rents than these other typical projects. So the actual total investment return, when you consider that growth, when you look further in the future, is actually going to be greater. So therefore, he's willing to do a 10% project here compared to an 11% as the norm, right? So, but by 1993, it's not even, it's really terrible, right? What's this number in 1993? Alice.
Okay, 6%. So it's
Okay, and it's at
12.5
12.5.
divided by 197.
Right. The revenue's gone down, the costs have gone up, and this is only a 6% return on cost, which these days, today, that wouldn't be too bad, but back then, that would be a horrible, way too low to do an investment. The loan amount, you guys had to use a little bit of what the TAs have been going over in citation. So let's generate another random student here.
It is Derek Price.
Here.
So for loan amount, again in dollars square foot at 80% in 1984, we had 134.40.
Okay, 134.40. And in 1993,
At 70%, we had at 137,860.
So, yeah, the market was only provided, you couldn't borrow as much in 1993 per dollar of cost as you could in 1984. Because in 1984, there were, in real estate was hot. There were a lot of investors, in particular, there were a lot of banks, especially savings and loans. They really wanted to invest in real estate. They really wanted to make commercial mortgages or construction loans. So they were willing to lend up to 80% of the total development cost. In 1993, they'd all been burned by this crash. They were a lot more conservative, and nobody would lend you more than 70% of whatever the costs are. So that's why the difference there. And I'm sorry, what was the number again?
It's 137,660.
So it's 70% of the 197, right?
Correct.
Is what is it?
137,660.
Okay, so you're actually borrowing only slightly more than you would have back in 1980, but you're only getting, you have to put more equity in, right? You have to put 30% equity in instead of 20%. And so the equity investment is going to be a lot greater. Okay, so the debt service here, which is the annual loan payment, which includes the interest as well as the amortization of the principal, paying back some of it.
It was 2.1 million, which is
So 2.1 million divided by the 148 square feet.
$14.20.
1426. And what about 1993?
I gotta change my.
And this is 10% loan, right?
Mm-hmm. Yeah.
So notice, so we're borrowing 134, and we have to pay each year 1426. That's a bit more than 10% of what we're borrowing. That difference is the amortization. You're paying down a little bit of principal in addition to paying the 10% interest. And the same thing's going to happen in 93. Cut to the chase here. Should be 1459. Okay. Let me make this smaller. So cash flow to the investor after paying. So we already looked at some cash flow up there in terms of the net operating income, right? That's the cash flow generated by the property asset. Not all of that comes back to the investor because the investor has borrowed money here and so he has to pay some of it to the bank. So what's left over for the equity investor, for Lindy, for Boston Properties, is the equity cash flow that we're coming with here. So it's going to be just the cash flow that we started out with up here, the net operating income minus the debt service, and that's going to be in 1984, right? It's going to be the $17 minus the 1426. So that is, it's 274. $2.74 per square foot. But in 93, that's where we got our negative situation. We got $12.50 net income coming into the property, and we're paying out $14.26 each month to the bank. That is not good. So not only is this thing negative if you just compare the value of the asset with the cost of producing it, but it's also negative on an annual cash flow basis where your money is actually going out the door each year that you're going to be owning this thing. to the tune of 1250 minus 1459, which is going to be negative 209. Okay, and then if we just take that equity cash flow bottom line and divide it by the equity investment is the total construction cost minus the amount that you borrowed from the bank. So it's the 20% of the construction cost in 84. It's the 30% of the higher construction cost in 93. And that number is going to look like 8.2% in 1984, which was, I guess, an okay number, but it's going to be less than 0 here, which is obviously horrible. So the case told us some stuff about what are good numbers here in terms of cap rate on cost and cap rate on value, and a 9% is the market initial yield on the assets. 10% is what anyway for this project seems to be okay on the costs, but it doesn't tell us anything about what this number should be. It's 8.2%. Is that good? In 1984. Okay, this is a much more difficult number to know what it should be, because it depends on how much more. What's the effect of this leverage on the risk in the equity investment and on the growth, the future growth in the equity investment. And it depends even on other stuff. So this is a number that people do look at it. Some people think they know what it means, or that they think there's a good number for them, but it's a lot more squishy of a number than these other ones that apply to the asset. And as we get further into this course, and in particular in Module 3, where we really rigorously bring in debt and even income taxes, see the better ways to analyze these kind of investments from the perspective of the equity and the debt. And so actually this bottom line number at this point, it doesn't really tell us a whole lot, except I can tell you one thing: when it's less than 0, that is not good. So any questions? We now have done our back-of-the-envelope economic analysis of this project.
Professor?
Yeah.
I think you had a typo
Okay.
in the loan amount in 1984. It should be,
Which line?
the loan amount for the year 1984.
Okay.
Should be 0.8 times 168. And give the
Yes, of course. Yes, thank you. Okay. Right. So, of course, this is just working out everything that we just stepped through for 1984. You guys all good with all this? 1993. And this is our carry cost. Now, here's a very important question. What is the meaning? Why do you care about that $7.3 million? It's a sunk cost, right? Yeah, if they had invested the $3.1 million in an account that would pay 10% during those 9 years, it would have grown to $7.3 million, which they don't have now. But so what? That's water over the dam. What matters now, in terms of making an investment decision, in terms of what is the value of the land today, therefore the cost of not selling the land, let's say, is what the land is worth today, right? So what they would be giving up by doing this project today, in terms of land value, is what they could otherwise sell the land for, right? If they do the project on the land, they can't sell the land. If they don't do the project on the land, they can sell the land. And so the value they could sell it for now, that's the opportunity value. That's or opportunity cost, whichever way you want to look at it. The important number that matters for making the investment decision today, not the 7.3 million number. So it was a trick question. I was faking you guys out. You didn't really even need to calculate that. It didn't really matter. But still, it's good exercise for you. But so the question is, what is the land worth today? And we've just seen the development project today does not look very good at all. In fact, it looks like a total loser. So today, the land is not worth anything for development if you had to develop it today. Now, that doesn't mean that it doesn't have development value. Remember, there's a call option there. You don't have to develop it today. You can hold on to the land, and maybe in a year or 2 or 3 or 5, it'll be hugely profitable to develop on that land. And so the land may indeed have development value, but at least for a project today, it clearly doesn't. But the land clearly does have a value today because Don Henley, all those guys, you know, the land has a value for the conservation and willing to pay an amount for it. And it turns out what they actually did is indeed they sold the land to the conservationists in 1993 for $3.4 million. So this is actually the value of the land, I would say, right? The highest and best use of that land, at least at that time, was not development, it was conservation, you know, selling it to the conservationists. And so this is really our relevant number for computing the economics of the investment project at the time. So we were being too hard on the thing by counting those costs in at $7.2 million for the land. So let's redo the numbers with now the $3.4 million opportunity cost. And it still looks like a bad project. Okay, still looks like a pretty much of a loser by these simple back of envelope numbers anyway. And so by selling it to the conservationists, Boston Properties was not actually doing a charitable, you know, thing. They were probably maximizing the return that they could possibly get for their shareholders at that time for that investment. So, does everybody see this? Okay. So, here's back to our question. Was it a good investment at either of these 2 points in time? And now we've done some quantitative analysis. And what do you guys think? We can have a small little bit of discussion on this before we go into our other topic. So let's generate another random student just for fun.
Matthew Jones.
Matt Jones, all right. We are going to get it. What's your thinking on it, Matt?
Well, when we were originally asked this on the first assignment, I was looking at the sort of political environment of that case.
Right.
And saying definitely not. Because Boston Properties puts itself forward as being kind of a best-in-class company, and I think that prides itself on its past work, and so getting into this type of situation where there's negative publicity, it just didn't seem like it was really fitting with their values.
Right, but here, let's be careful because we want to answer this at 2 different points in time.
Mm-hmm.
So 1984, when they made the initial decision to buy the land, at that point, there hadn't been any controversy yet, and there wasn't really any, didn't seem like, the case seemed to imply that fairly well-educated, reasonably astute person, even somebody fairly familiar with Concord, would not have guessed that this would have blown up into a big controversy because it's across from a dump, the land itself was nice. So in 1984, that wasn't really a reason to say it was a bad investment, I don't think.
Right.
Or a good investment either. So, I mean, and in view of the economics that we've just gone through, as of 1984, what would you say?
I would say if at the beginning it was a very smart project because the 8% is okay, but the expectation is that the boundary of the city is going to grow, and so that you're going to have a asset over time.
So you're saying 8% okay. Although we don't really know why 8% is okay. I'm going to back you up a little bit and say it's more like the 10% is okay. Even though it was 100 basis points less than usually amount of profit. So you're going to go with the idea that this is going to catch a wave, it's going to provide better growth than the typical property, and that's going to justify the difference between the 11% and 10%. Okay, what about 1993 then?
not, so in 1993, you have first and foremost the nationwide political controversy that you've instituted, and secondly,
Right.
you have a greatly depreciated economic model justified.
Right.
going forward.
But you have both political problems
Reputation.
plus economic. It's economic and financial problems. And what do I mean by the difference between the economic and financial problems? The economic problem is the fundamental economics of the project. It can't generate enough rent to cover its construction costs. Never mind how you're going to try to finance it or what. The economics are not there. Financial problem is you can only borrow 70%. The lenders are, it's more difficult to come up with the cash. You have to put 30% of your own money in there, and so there's both those kind of problems, and they're not unrelated to each other.
And lastly, I would add, you also have virtually another decade of the city growing to see if your models had borne out. in terms of
Right.
the expansion of
Good
the
point. Good point. Yeah. So yeah, maybe by then already. I'm saying maybe by the early 1990s, nine years later, it was becoming clearer that the next node or the next center of the sort of the high-tech office, highest and best use, these high-rent kind of tenants were skipping all the way out from 128. They were going out to 495, and in fact, during the 1990s, 495 really boomed. And there was a lot of demand to be out there. So the basic premise that was underlying why Lindy thought it'd be okay to build at a 10% profit when normally you'd require an 11% profit, even that premise maybe was disappearing by the early 1990s. So good point. All right, anybody want to add any other comments or thoughts about it? Yeah.
So the 1984 investment at 8%, if you're getting an 8% return, but you're borrowing at 10% from the bank, wouldn't it be more reasonable? This is a spec office development with all sorts
No,
of.
but returns, you got to be really careful there. The 8% is just an initial cash yield, and that's already net of what you're paying to the bank. So you have to, if you're going to compare returns on the property, if you're going to compare a return to the rate you're paying on the interest on the bank loan, you have to compare the return that the underlying asset is generating, the asset from which you will pay that interest. And that's the property itself, which is paying the 10% on cost. You're borrowing a fraction of that cost. We said the loan also was 10%, so basically you've got something that's paying 10%, and you're paying same rate out on the borrowing money. But the difference is the loan, you're always going to pay 10% on that, whereas the property, presumably, hopefully, it can grow. And so while you're initially years, you'll be earning more than 10% on the initial cost, the amount that you borrowed on. And so, so the equity, which is what's left over, would grow quite a bit. And you'll see all how to do this all very rigorously and quantitatively as we go into module, the subsequent modules, especially module 3. Yeah.
Can I just ask one more question about where it is in 1993? If you just take out from the case the sort of the political and reputational thing that happened, is one of the potential possibilities is that your option is sort of regenerating itself again. So he could see ahead to the next boom and say, I could even build a bigger building here. I'm so glad I waited because I'll make even more
Yes.
money.
That, absolutely, and that's what I meant by the fact that even though the thing is a total loser right now, if you wanted to make an immediate development on it, that doesn't mean that the land doesn't have development value, and it is this option. And in fact, the reality is, and I think I have some slides here where I did pursue that some more, but I don't know how much time I want to get into that in this class. Yeah, let me take a few more minutes to show you a little bit more of the economics here. And let me start out by just reviewing the way that get sort of my bottom line on this in terms of the economics. We've got a 10% cap rate on cost in 1984, and let's give them the benefit of the doubt that's good enough at that point. It's down to 7.4% in 1993 based on the land opportunity value. While I can buy that, like what we just said, that in 1984 the 10% is okay, even though it's less than the 11%, because of thinking that you can get greater growth. By 1993, 7.4% is quite a bit lower than, let's say that 10% would still be okay. Well, 7.4% is quite a bit below that in cap rate terms. So, from that perspective, maybe it's okay in 1984. It definitely doesn't look good in 93. Right? Now, the point here is that this metric that we're using to make that decision is a very simplistic metric. The cap rate only considers income. It ignores the capital gain or the growth in the investment. And it's only looking at the first year, not what's happening in subsequent years. Indeed, it's that consideration that makes us try to explain why the 10% could be okay instead of 11%, because maybe it's got more growth. We haven't talked about risk and how to account for that. So we haven't really talked about what is the real cost of capital in a meaningful way here. So we try to delve into a little more depth on this. Here's a very simple economic model of this project. This is like what I showed you on the first day when we talked about that project in Milpitas, California. We're just computing the net present value. And we're saying that this is looking at it in 1984. The project creates an asset that can generate $17 of net income per year. And in the property market, with the 9% prevailing cap rate, and multiplying that times the 148,000 square feet, that's going to produce an asset that's going to be worth $28 million. And the total cost, apart from the land, the total cost was going to be, the total cost including the land is going to be $24.9 million. So that's actually $21.8 million of construction cost. So let's say basically at the end of the project, when the project's completed, we're going to get something worth $28 million, and we're going to have to fork out $21.8 million to pay for the construction. That included the construction loans. But in order to do that, what we're investing up front, what we're giving up front, is the ability to otherwise sell the land, which we've just bought. Or another way of looking at it is we have to buy the land, which at that time was $3.1 million, right? So the upfront investment is a negative 3.1, and then in return for that, we get 28 minus 21.8. And we get that, let's suppose we can get that in 1 year. And let's suppose that for a risky investment like this, you need a 25% return to make that economic, to make it worthwhile, to compensate you for both the time and, more than that, the risk that's involved in this project. So you need to be, the return is not guaranteed, but you need to be looking at an expected return going into this thing. You need to be looking at an expected return of 25%. So we take that net that you're looking at there at the completion of the project, 6.2 million, the difference between the 28 and 21.8. Discount that at 25% for 1 year. Compare that with the 3.1 million that you're forking out up front to get it, and that's the net present value of the project, and it looks like a positive, right? So requiring this pretty robust expected return, the project looks pretty good economically if you can build it in 1 year. Okay, so this is one way to look at it. If you want to compute an internal rate of return, in this case, you're getting 6.2 in 1 year. You're investing 3.1 up front, so that's a return of actually exactly 100%, right? Doubling your money. So the expected return, if this is good expectations, is 100%. The cost of capital is 25%. Your the hurdle is 25%, you're looking at 100%, that looks like a good investment, right? If you can do it in 1 year. Now, where did the 25% come from? Well, in Module 4, you will learn rigorously how to compute what is the opportunity cost of capital of any development project. Right now, you don't know that. This number comes out of the air for you, but trust me, it's not a bad number. In the 1980s, risk-free returns were about 8%. Government bonds, right? And so this would imply a 17% risk premium. Well, the typical risk premium for unlevered investment in, stabilized property would be about maybe 4%. So this is 4 times the typical risk premium for an investment in stabilized properties. Basically saying that the development project, because it's a development project, has like 4 times the risk of investing in a building that already exists, already fully leased out, you know what the rent is and everything. And that turns out to be not untypical of the amount of extra risk that's in development compared to stabilized investment. So it's a reasonable guess at opportunity cost of capital. Now, what if, on the other hand, it's going to take us 2 years? Then we got the same numbers, except for now we have to discount what we're getting by 2 years instead of just 1 year, right? So 25% discounted 1 year, we just divide by 1.25, but we got to compound this, right? So discounting it for 2 years is 1.25 squared. Okay, so now the present value is less, and it reduces the net present value from 1.9 million to just $900,000. But still, that's an IRR of 41% compared to our cost of capital of 25%. Still, the project looks like it would be good if it's going to take 2 years. What about 3 years? 3 years, now we have to discount for 3 years, so we have to cube the denominator here, right? Still just squeaks by. It's still got a positive NPV. Or what we really just need is just a non-negative NPV, because we're already accounting for the required expected return, including the profit that's involved in that 25% return there, right? So even if it would take us 3 years to get these numbers, it's looking like the project's okay. Right? So maybe this is the way Lindy was looking at it. Of course, if I go beyond that, it takes 4 years, then now we're in negative territory in terms of NPV. Because now our return is only 19% per year, when our cost of capital is 25% per year. So if it's going to take 4 years, then it doesn't make sense, assuming that the numbers are staying the same. Now, what would happen if, as we go out 4 years, suppose the construction costs maybe are going to actually increase a little bit. But suppose the value of the real estate, the net rents it can charge here, is going to increase even more, percentage-wise, than the construction costs. Then this thing could still work even after 4 years. But those are big assumptions there, right? I mean, it's not too bad of an assumption to assume that the construction cost is going to increase. But it is maybe a bit of an assumption that the real estate value will increase. However, in 1984, people were standing on about 5 or maybe even 10 years of history of real estate prices really rising. More in nominal terms than in real terms, because there's been a lot of inflation. But nevertheless, a lot of rising of real estate prices, double-digit increases in real estate prices, whether you're talking rent or values. And so it would have been pretty easy for people to be in the mentality in 1984 to think that, well, okay, so even if I do have to take 4 years to get this thing out of the ground, probably it'll be okay. I'll charge more than the $17 of rent. And even though the construction might also be more, I'll be in good shape. So that's another way of looking at it. Now, we know in retrospect, and maybe they should have been able to know even then, that they were actually near a peak of real estate values, that real estate values are very cyclical. And in 1984, they were near a peak. And so instead of it actually being realistic to assume that the real estate values might grow over the next 4 or 5 years, it would have been more realistic to assume that maybe they're going to be level or even start to fall. And of course, the reality is that they did fall. So, but that's partly why you demand a high expected return, because of the risk that's in there. And John.
So why do you only put the land cost at the beginning of the period, but put the rest of the cost at the end of 4 years. Why is that?
This is like basically making sort of viewing the project as though you are committing to do it now, and in fact, they did buy the land then. And then you get it whenever you manage to complete it. So you are incurring this cost up front. It literally is a cash outflow. And then you will get a return on it in the future when you complete the project, but not before then. It's trying to register the cash flows when they actually happen. Yeah.
I'm not sure if I'm being a bit too nitpicky, but and I'm not sure how it happens in real life, but I would assume that some construction costs would come in at the end of the first or second year, and having such a high hurdle rate, that might actually make your project.
No, that's a very good point. And his question is that some of the construction costs you'd actually have to pay it before the end of the period. But, and this is not untypical of the way it works in the real world, you're typically going to be borrowing most of that construction cost money. So you will have to pay it, but only at the end, and then you'll have to pay also the interest on the construction loan. But that was factored in, although probably only 1 year of it was factored in, or 2 years or something. I don't know. But you're right. That alone, just in terms of increased construction cost, well, you might not even start the construction. A 4-year project might mean that it lays sort of vacant. You go through permits and stuff for a couple of years. And then you borrow the money and you start the construction. So there might not be any more construction interest in this construction cost, in this 4-year timetable than there would have been in a 1 or 2 year timetable. Actually, it might have been less interest because interest rates did fall over that period, so you might have actually gotten a lower interest loan. But does that make sense? Okay, running out 5 years looks worse, 6 years looks even worse, 7 years even worse, and so on. Okay, and so you can easily do this kind of sensitivity analysis, and you see the NPV or the IRR as a function of how long it's going to take to complete and what rent they can get for it when it does complete. And when you do this, the project looks like, basically it looks like reasonable in 1984, but by 1993 it looks very different. These are 1993 numbers, and I mean, this is not fully rigorously done, right? Because I kept the construction cost still the same, and here, but now I'm charging the $3.4 million opportunity cost of the land in 1993, and it looks like even if you could do it in the 1 year, it's negative NPV. So we're getting the same answer here with the slightly more rigorous and elegant economic approach than the sort of back-of-envelope ratio kind of cap rate kind of approach that Exhibit 9 did. And then we're getting the same answer, namely 1993 is not a good investment to do it. This is what actually happened in the future beyond that point in time. And I mean, here you're looking at the red line is the rents. And this is 1989, and we're going up here through 2009. So the rents actually bottomed out in 1993. So Ed Lindy was indeed standing on the threshold of a recovery, and he knew that. The case said he knew that, and because he knew about the cycle. Now, exactly how much it would recover, when, how far, he couldn't know for sure. Nobody could know for sure. But this is what it actually did. The rents went from the market rents went from under $15 a square foot to, they peaked in 2000, the dot-com bubble. They peaked at like $28 a square foot. That is a huge percentage increase in rents. And, vacancy rates also plummeted. You had a lot of absorption in the market, more than construction in the market. It would have been a great time. Not quite yet, but maybe in a year or two, it would have been a great time to build a building. They probably could have done very well with it. But of course, you don't know that for sure. And even then, they would have had to get a lot of things right. I don't know. I played around with a lot of numbers. You guys can explore that if you want at your leisure. I'm not going to try to get into all the details here. What did this project in? Was it the environmentalists? Partly, was it over-optimistic rent pro forma? Project too aggressive, even from the 1984 perspective? Arguably, that could be also a problem with it. Was it the delay in the start? Because remember, even before the environmentalists made any trouble, it was already like 1987 or something, and they still hadn't managed to get the thing started. So maybe that was part of the problem. The deteriorating space market with the overbuilding in there, obviously that was a huge part of the problem. And then the asset market crashed. Right, ultimately, was the thing a failure? And we're getting philosophical here, right? Because they did sell the land for $3.4 million. They only paid $3.1 million for it. $300,000, nice tidy profit in the land investment there. But we have this beautiful Bristers Hill Park, that my dog can climb on the rocks in. So they can take some credit for that. Right. I don't want to beat up on Boston Properties because they're one of our industry partners up at the center, and they hire our students, and they are a great company. They seriously are. They're one of the best real estate companies in the U.S. I'm not just saying that. This is just to point out that their stock price. They became a public company in 1997, and we can trace their stock price. I haven't fully updated this. Somebody, if you want to. On your own recognizance, bring this chart up to date. We're just comparing Boston Properties with the average REIT, and REITs on average have done better than the broad stock market. But Boston Properties is a winner, and here I updated it a little bit. But okay, so this is shifting gears. We're almost out of time already. This is the last point in Chapter 5, and it's really a pretty simple point. It's very important, very basic. It's just that structures depreciate. And that seems very obvious. And yet investors typically ignore this fact, or they don't properly take account of it when they do analysis of real estate investments. And so I want to make the point very clearly here. And we now can quantify this a lot better. And in fact, we have research ongoing right now here at the center trying to quantify what is the magnitude and nature of depreciation of commercial structures in the U.S. And I'm not going to have time to do it today, but maybe next week on Monday I'll take some time. I have a presentation that's presenting sort of our latest research on this, and I really want to go through this with you guys. It's posted on the resources section. Our postdoctoral fellow Sherry Bokhari and myself have worked with data from excellent data set, and we are quantifying this phenomenon, I think, better than has been done before, and analyzing it, and we will talk about this next week, but we're sort of showing that most of the depreciation results from the fact that the buildings can't charge as much rent. It's not primarily that the cap rate rises, that they have to sell the buildings for a lower price per dollar of rent. That's not what causes the depreciation. It's the fact that the rent goes down. Okay? Anyway, we'll get into all of this, I hope. We'll take a little time next Monday, but just to introduce the point, here's a dramatic example of the life cycle of buildings. So the last thing we talked about on Monday was the life cycle of a neighborhood or a district. And we talked about, say, the Herrencroft and how the highest and best use in a given zone or a given region of the city might not change much over time, or it might evolve in either direction. But as an investor, you don't realize the value of the highest and best use of the neighborhood you're investing in. What you're investing in is a specific building. And no matter what's happening in that neighborhood, your building is going to be depreciated. So you could have, and we talked about, there's often a pop in the neighborhood, so highest and best use value, the usage value or the location value. You have a pop when a neighborhood first becomes ripe for development, and then it may be mature for a long time, and then it may go down, it may go up, it might continue. But during all of this time, when the value in real terms, netting out inflation, the value of the buildings that make sense to build there is about the same, what's going on in that neighborhood is new buildings are getting born all the time, and old buildings are dying all the time. And so the value of existing buildings is like going down. And what you're investing in as an investor is it's not this line here. It's it's one of these, that's going to go down. That's the depreciation. So here's an example of it. This is the corner of 33rd and 5th Avenue in New York, right, 34th, wherever the Empire State Building is. I guess it occupies a whole block, right? So we have to give it several numbers. But that site clearly was very valuable, and probably getting more valuable. It was probably in one of these kind of situations here. And they built the Waldorf building. Was built in, I believe, the 1880s. A beautiful building. And by 1929, it's still a beautiful building. It's still a fine building. I'm sure whatever it was, I don't know if it was an apartment or a hotel. Who knows? New York history buff?
It's a hotel.
It's a hotel, okay. So I'm sure it was still a fine hotel in 1929.
It's still a hotel, it's just in a different location.
I'm sorry?
It's still a hotel.
Right. Is it the Waldorf Astoria? It's a famous hotel. So, but this building in 1929 is worthless, right? It's fully depreciated because at that point they're going to tear it down and they're going to build this one, right? And now, will they ever tear this one down? I don't think so. I hope not, and hopefully it will remain for a long time. But when it was new, it was at least supposed to be a Class A office building. Supposed to be able to charge like the highest rents per square foot in New York. Actually, it was completed in 1931. You think the Depression, the Great Recession in 2009 was bad? Nothing compared to that. So it was a total failure as an investment project. And then I think like the first three entities that took it over all went bankrupt. The initial developer, that project went bankrupt and got taken over by somebody else, and then they did, and so on. But eventually the thing got its legs, and it was probably a Class A office building for a while. But by 50 years later, already it's a Class B or Class C. It doesn't have the right kind of floor plates. It's not even in the ideal location for Class A office, too far south. So it had depreciated, the Empire State Building. And although they didn't tear it down, and I don't think they ever will, they did recently put $500 million into it. That's a major investment. And they turned it into the green Empire State Building. I don't know how really green it is. Maybe one of you guys knows, but they reglazed it and did a lot of improvements to it. So this is what happens with individual buildings, which is what you're buying when you invest in a building. Here's a depiction of what's going on. On the horizontal axis is time, a lot of it, like maybe centuries. When the vertical axis is value, And we can think of several different values and several different components. At the top here is what I usually call the usage value of the site. You could call it maybe the location value. What it is, it's the value of the highest and best use of the site, as if the site were vacant at each point in time. And by the way, there's a typographical error in the book, in the textbook. There's a lot of typographical errors in the textbook. Almost none of them are my fault. Almost all of the publisher put those errors in. Really, they did. But this top line, which the book says is dashed, but it's actually a solid line, traces out like this value here, the value of the neighborhood in some sense. At each of these points, R is a point when there's reconstruction, redevelopment, right? So a bunch of capital is going to be put in, money is going to be put in to pay for construction to, well, first of all, you have to acquire the site, and you have to pay the value of the land, the acquisition cost for the site, and then you put in K amount of construction cost, and you get the thing that's now worth the value of the highest and best use of the site. And then over time, the structure is going to depreciate, so the property price, P, is going to decline over time relative to this U value at the top. And that's reflecting depreciation. The land value, we can define land value in different ways. The classical definition of land value, I call it L, that's the legal definition or the appraisal definition. It's what would this site sell for if it didn't have a structure on it, if it was vacant. And you can look at the land market, the market for vacant land parcels, and try to estimate what this land would be worth at any given point in time, right? Now, for this particular parcel, it's not vacant. It does have a structure on it, so that's really kind of a if pigs could fly, how would they fly kind of question. But the other perspective of land value is the one we've already talked about. It's the call option. The idea that what the land gives you, as distinct from what the structure gives you, is the right without obligation to tear down the structure and build a new structure. That's the call option, the redevelopment call option. That's another way to look at land value, and that I call C, call option. And that is going to be worth very little just after you've built a new building. The call option is deeply out of the money because you'd have to tear down this brand new building as part of the cost of the redevelopment. So it's not going to make sense. So the call options can be very low value. But over time, call options grow very rapidly in value on average. And there will come a point when, indeed, it makes sense to tear down the building and redevelop. At that point, the entire property value is just the land value. And whether it's either definition of land value, it's the same, right? The call option is worth that. And even if it was vacant and you were to sell the vacant land parcel, it would sell for that same price. So all the three values, P, L, and C, they all are the same at these R points in time where it's optimal to redevelop the site. So we can think of the P as consisting of two additive components, the structure value and the land value. The land value is depending on how you want to define it. It's either L or C. At the redevelopment point in time, everything agrees. Okay, so this is kind of the profile over time of property values. And the point about this, I call it the depreciation principle, is that what you as an investor are going to get in terms of your capital growth, your capital appreciation, is traced out by the thick P line. So we've talked about that, you're initially going to get this cap rate, this yield, this cash yield, the initial net income that you get as a fraction of the investment you made. But over time, you're going to get a change in the capital value of your asset. So your total return as an investor consists of these two components, the initial income and the growth in that income and or asset value. And the total return is the sum of those two. And if we look at that second component, the growth, it's governed by this thick line, not by the U's, not by the line of the U at the top. And that difference is depreciation, and that's what people are often ignoring, because admittedly it gets kind of hidden when there's inflation. Right? Because the depreciation is something that happens in real terms, whereas what you're seeing every day in terms of the current money that the property is generating is nominal dollars, current dollars, that are losing their purchasing power. So So that's the basic point about depreciation, and it comes from three sources. I'll get the numbers in a minute. Three sources of depreciation. Physical obsolescence, the building is simply wearing out physically. It's becoming more expensive to maintain it. Functional obsolescence, the building is like, the blush is off the rose. It's like the needs and the preferences of the potential tenants, the users of the building, have changed since the building was designed. So even though the type of usage, the type of tenant is the same as when the building was designed, in terms of the highest and best use kind of tenant, the particular design of this building is out of date. It doesn't have some of the things that users of that type now want in a building. So you have to discount the rent to get them to be willing to rent there. That's called functional obsolescence. And then economic or external obsolescence is when the highest and best use of that site has changed. Like maybe the Waldorf Astoria thing, the highest and best use had been a hotel, and now the highest and best use is a world-class skyscraper. So now you're going to tear down the building. Even though it might not be functionally obsolete, it might not have much physical obsolescence, it's still economical to tear it down and replace it with a new building because the highest and best use has changed enough that it makes sense to exercise that call option. So these are the three sources of depreciation. If you want to quantify it, it depends on two things. I have a quick example here. It depends on how long is the building going to last. How long is it going to make economic sense to not tear the building down? In other words, how long between those are points in time? How long between these points in time? And when you come to the end of one of those stretches, what is the fraction, what fraction of the original, of the ultimate value is the land value? In other words, it's depreciated, because you still have the land value, right? So the structure has depreciated down to nothing, but the property value by now being just land is what fraction of what ultimately you will get. And those two parameters are here. Basically, we're saying that in this example, it said, suppose that it takes 50 years for the building to become totally obsolete. You're going to tear it down. And at that point, the land, the acquisition value of the site, is 20% of the total value that you can then obtain by putting in the construction cost. So that means that over a 50-year period, what started out as a whole property value has depreciated down to 0.2 from what it started out with. So just solve this algebra, and it's a 3.2% rate per year relative to the top line here. If the top line is going up, then it's 3.17% below whatever this growth rate is. But remember, we're talking about real numbers, net of inflation. So oftentimes this top number here won't be going up, right? If we're in kind of a typical neighborhood that's mature and it's kind of keeping its same highest and best use over time, then probably that top line is going to be flat. So I'm going to shut up now, and we'll probably pick up a little bit with depreciation on Monday, but you also have a homework for that, and we'll go into chapter 6. One last question.
Numbers on the slide that I had to work answer, but the 0.2 was the percentage value of land.
This is the land value fraction at the time of redevelopment, 22.
And the 50 is the number of years.
50 is the number of years between the redevelopment time.